Good evening, everybody. Tonight we've got the great pleasure of having Kirt Christensen with us. He's an internet entrepreneur and stock market investor who started his first company back in 1996 at the age of 23. Since then, he's generated over $29 million of online sales and placed thousands of trades in ETF stocks and futures as well as options. In the past few years, he's spent over $95,000 just to get his own stock market systems in order after what he calls ditching the mainstream advice and methods. So right now, he's got a system where he can trade the ETFs and make it so that the investor only has to spend less than an hour a week and still maintain profits of somewhere between 5 and 10% a month. So with that, Kirt, welcome to the Candlestick Forum. We're anxious to see the system.
Hey, thanks, Stephen. Hey, thanks for having me on. This is quite an opportunity to be here. I greatly appreciate this time to spend with you all here today. Summer afternoon. I don't know where you're at in the world, but hopefully you're enjoying the beginning of a fabulous summer. So let's go ahead and dig in. As you know, a lot of crazy things are going on in the markets right now. And just today, so here's an update, of the last week of what's happening. Just kind of show you where we're at. And obviously, I'm not an investment advisor or anything like that. And this isn't, but the market's looking extremely bearish. This is kind of a recap. This is our box score, what we call it, of our ETF tipping point system as of last Friday. We were bearish on the Dow, bearish on the SPY, bearish on the Qs, bearish on the financial index, bearish on oil, bullish on gold, bearish on semiconductors, bullish on real estate, and bullish on materials. So today we're going to talk about, well, exactly where do all these numbers come from? How do we get these results? And of course, this webinar video is provided for the express purpose of disclosure and proprietary investment system. And the very last line on there is the most important. The last paragraph, fourth paragraph. The past results of any trading or investment system are not necessarily indicative of future performance. So that said, why should you listen to me? Go through this very quickly. Stephen already gave us a fabulous introduction. I'm the initial internet boom. So I actually sold an internet startup for $11 million back in 1998. And since that markets, I've spoken at seminars all over Russia, Costa Rica, and the most crazy seminar of all was actually in India, for many reasons. But I've actually been featured in a few best-selling books on the internet. Noodles on the Late Shift, How to Get Rich on the Internet, Click Here to Order. But every time I've turned my investment dollars over to others, it's bombed. I haven't had any problem making money. Haven't had any problem with revenue. But every time I've turned it over to somebody else, things have crashed. An investment advisor or a mutual fund advisor, and I'm sure many of you on this call today have had that same experience. Before you started working with people like Stephen, it was easy to make the money and then turn it over to advisor, and then the next year, you have to go into that dreaded annual meeting where they tell you that they lost more of your money. But on the flip side, I have zero desire to day trade or be chained to my desk. In fact, I really only have realistic but also doable is to get way above market returns, lots of compounding, and the ability to do this all in 15 minutes a week. So show me the money. What are the results of this system? Like we've talked about. All right, so we were talking about this box score. So this box score represents the results of the system over 9+ years, 9.5 years. So this is good markets, this is bad markets, bull markets, this is sideways markets, and this is bear markets. We've averaged 3.04% just using single ETFs. So, obviously on an annual basis, that's north of 36%, not even counting compounding, and that's not even doing anything sophisticated or doing anything with options or double ETFs. So that's kind of the baseline of what we're talking about. We're not talking about home runs. We're not talking about triples. We're talking about solid singles and doubles month in and month out. That's the kind of trading. When we put $10,000 into each of the 9 ETFs, our $90,000 would have turned into $3,042,497 with compounding, which is at 33 times increase. That $90,000 would have turned into $407,000 with zero compounding. Okay, so if we have questions as they come up, if you miss something, obviously it's going to be on the slides and in the recording, but just jot them in the notes, and we'll make sure we try to get those answered. So the final results of this, what we're talking about is, if we took 9.5 years ago and put $10,000 in each of the 9 ETFs, that $90,000 would have turned into $3,042,000, a 33 times increase, or $407,000 with zero compounding. So somebody asked, are these actual or hypothetical results, actual theoretical results? Well, we have to list them as hypothetical because we don't use an audited control account for this, but these were signals generated in real time. These are not back-tested signals back to 2007. We've been generating these signals in real time since 2007. It's an artificial index designed to exactly mimic the underlying basket of stocks without a lot of changing what's going on. There's no management fee. So if we're looking at the Dow Jones Industrial Average, this is the $DGI, depending on your broker, maybe slightly different. But DGI, this is the ticker symbol for the industrial average. This is DIA, is the ticker symbol for the ETF that trades exactly like that underlying average. So why would we want to trade ETFs? Quite simply, is they have lower expenses. They're very tax financial flexibility, consistent market performance, and they have a mass appeal. Basically, if you're looking for a sector of the market that you want to trade, there's probably an ETF for it. When I started getting interested in ETFs going all the way back, even before 2007, I remember when I was shocked when the ETF numbers hit 500 total ETFs. And now, we're over 1,500 ETFs at last count. And the number seems to go up and up and up. So here's how we come up with these signals. So by definition, for me, technical analysis is 50 years of traders arguing about what stuff works sometimes. And some of this is going to be a little bit controversial. Well, that's perfectly fine. Take this with a grain of salt. This is what I'm trying to talk to you about today. For example, if we go into Amazon and type in technical analysis, we can see that there's over 50,000 books that match up with that phrase, technical analysis. So here's my other controversial statement. Moving averages suck. The reason for that is on their lonesome, by themselves, without any other support or without any other confirmation. And if you look in the market, you're going to notice, if you go to any Barnes & Noble or look on Amazon, there's books and books filled with, 60 or so different oscillators. Shouldn't there just be one by now? The answer is that moving averages by themselves isn't just going to cut it. Let's face it, we really only have 3 basic elements to work with, and everybody's looking at those same elements, price, time, and volume. So everyone scrambles to put their name on a proprietary indicator that attempts to manipulate the results in a slightly different way to produce a slightly different result from the next guy. The basic failure of all these is simple. They all use moving averages, whether you call it Bollinger Bands, MACD, stochastics, parabolics, runes, or Keltner channels. And the problem with moving averages is not that they don't work, they just don't work all the time. We have periods where the market goes flat, and if the markets are flat 40% of the time, are you going to try to rely exclusively on moving averages to make stuff work? So for the last 15 years, I've avoided moving averages like the plague for that. Look at stochastics, my own secret sauce of 5-3-3, but only when I'm watching for a trend change and confirmation. I don't even use candlesticks anymore, even though I studied them for over a year. I love what Steven's done, and I definitely highly recommend his work because that kind of combination is crucial in the market. Candlesticks applied with other measures. But when it comes down to it, I want to be able to look at things that don't exist in a free trading package, things that don't exist in every free data package under the sun. Because whenever you're dealing with the pack is invariably wrong. So again, the controversial statement: moving averages suck. So that gets us down to what are we looking for? How are we going to make a decision on how to enter into these different trades? Well, number one, we're going to start with stocks and ETFs that have options available on them. I don't care whether you trade options or not. It has been proven that optionable stocks have much greater investor interest and equate to a much better trading vehicle. Optional stocks have an average of 2.2 million shares traded per day as opposed to non-optional stocks that have just 119,000. So I look at ETFs, which are really just the proxies, and we then recalculate, okay? Because sometimes ETFs today are either on a price weighted, market cap weighted, or equally weighted. My opinion, just to cut to the chase, is the only sensible way to treat these is equally weighted. What we're trying to look for is a sector move across a whole sector. So, represented by incremental moves in any of those stocks. So, for example, for the S&P 500, every stock has a 1/500th weight, whether it's $100. And that allows us to sense out exactly what's going on in the underlying sector. So then we look at what we call the on-balance volume. So on-balance volume goes all the way back to 1963. Joe Granville in 1963 wrote a book called The New Key to Stock Market Profits. This was the first and most popular indicator to measure both positive and negative volume flow. And the concept behind that is very simple. And this is the biggest takeaway I want to give you today, is volume precedes price. That is the underlying basis of everything that I've done for the last 9.5 years on this system. Volume precedes price. And what does that mean? So quite simply, OBV, or on-balance volume, is a very simplistic indicator. It's kind of like addition, or addition and subtraction. Once obviously you get into higher mathematics, and they're very useful, but they're very limited. On-balance volume is exactly the same thing. But you've got to give it a break. It does go all the way back to 1963. So if you think of the computing power and the processing power and the data that was available in 1963 compared to now, obviously we're light years ahead of that. So on-balance volume is a simple indicator that adds a period's volume when it closes up and subtracts a period's volume when it closes down. The cumulative total of the volume additions subtractions forms what we call the OBV line. This line then can be compared with the price chart of the underlying security to look for divergences or confirmation. So as stated, it's calculated by adding the day's volume to the running cumulative total when the security price closes up and subtracting it when the volume closes down. Quite simply, and we subtract it if it's lower. So, but like we mentioned with this indicator going all the way back to 1963, what kind of progress have we made in computing power since then? What kind of progress have we made since then? I don't even want to imagine what trading stocks was like in 1963. It was probably pretty scary. I mean, few people did it. The data was unbelievably expensive. There were no personal computers. So you're looking at charts that you got in the mail, in the big catalogs that they used to have. So fortunately, today we can apply the same updates to how we look at the data itself. So what we're doing is we created a new dynamic volume indicator, what we call the ETF tipping point. So what we do is we look at every single stock that makes up every single stock inside the ETF. So that means for the S&P 500, we keep a running total throughout the day as to whether there's more buying than selling going on every single trade, tick by tick. So pop quiz, how would we know whether there's more buying or selling pressure going on every single trade, tick by tick? What are we looking at to know whether there's more buying pressure or more selling pressure? Well, what we do is we evaluate the bid price and the ask price for the trade. And if the sale went off closer to the ask price, then the sellers were willing to hold out for a higher price and the buyers were willing to pay a little bit extra. Conversely, if the sale goes off at the bid price, then it was the sellers who were willing to move their prices down toward the buyers who were in control, able to force the hand of the sellers to reduce their price. So this then establishes a positive negative tick volume, which, like Granville's original idea, allows us to set up with greater confidence who's the power, with the buyers or with the sellers. So now at the end of the day, we can look at a losing day, but we know that on balance, it was actually a bullish or bearish move for the majority of the stocks. At this point, we simply do a cumulative summation for the next 13 sessions. End of that time, we now have a pretty good idea of what percentage of stocks are advancing on hidden power or failing despite rising prices. So in the S&P 500 example, at the end of the day, we know out of 500 stocks in the S&P 500, how many are on positive footing with greater than 50% with more real accumulation, how many are negative. So all of this is done without the single use of a moving average. And like we mentioned before, I consider anything that uses moving averages to be suspect because it's just so widely available. The data is in every free trading platform. Some of it's self-fulfilling. Sometimes, obviously, trades do bounce off those specific points in moving averages, the 200-day moving average, the 50-day moving average, and things like that. That's because the data is available. What you're looking for is some way to trade the market using that price, time, or volume data in a way that, because that's how you get these outsized gains. So, so let's kind of go through the process. 3 steps. At this point, I am going to assume that you've decided to forego the development of your own tick-by-tick collection platform. You're going to just use our signals or something similar. I don't have any problem with that, of course. I like this business more from a theoretical standpoint than anything else. It did cost me about $95,000 in programming, 9.5 years to keep this going. To set this all up, to analyze the data, and to process it according to that simple formula that I talked about. Because we are dealing with, just in the S&P 500 sector, 500 different stocks of which we're calculating whether the sale went off closer to the bid price or the ask price on every single trade, tick by tick. So obviously we're talking about a lot of data. So what we do is we send out the signals every day about 12:30 p.m. Pacific, 3:30 p.m. Eastern. We do offer it by text or email. You can trade the next morning if you can't see your trade during the day, but you do lose some advantage on our returns. Our average customer, the people that we deal with, is your doctor, your dentist, your CPA, somebody that has a little bit of time flexibility at that midday or mid-afternoon time point to check on a few trades, but also doesn't want to be chained to their computer all day long. And then, of course, there's multiple ways to trade this. If you're been around trading for any length of period of time, you know that we have, besides the single ETFs, the plain Jane version, so to speak, right? We have double ETFs. And so you could buy or short the ETF, or buy calls or puts on the ETF, or buy the double ETF, or buy puts or calls on the double ETF. So there's at least 4 different ways to trade this that we can talk about right now. Double ETFs, options on the single ETF, options on the double ETF, and then we'll talk about a 5th way here in a minute. So then we simply hold that position until we receive a signal to reverse or until we get stopped out. Of course, there's another hundreds of ways that we could add on to this. I have all kinds of people that trade spreads with this. We have people who trade straddles and strangles. We have people who trade just solely directionally. We have people who trade condors on this. Any number of things depending on exactly what your trading preferences are. But we're giving you the basic core positions, whether you should be bullish or bearish on these massive sectors of the market. S&P 500, the Dow, gold, oil, semiconductors, real estate, and on and on. So, of course, you could be in a cash position if your trade gets stopped out. In that case, you would just wait for the next signal and re-enter on the next trade. An ETF is either going to be bullish or bearish. If you're only comfortable playing to the upside, then only trade with bullish and go to cash for that ETF when they're bearish. So this is the status of the system as of last Friday. So of course, like any real system, we don't have 100% winners or anything like that. But if you notice, any of our trades that have been on, right there in the middle column, any of our trades that have been on for a substantial period of time quickly turn into green trades, which means they're profitable. Right now, like we talked about in the intro, with the whole Brexit and all that stuff going on with the UK right now, the market's in a state of flux. But our ETF tipping point system, we're confident, is in a bearish stance, and hopefully in the next few days or so, we have a couple of those marginally losing trades, down a couple percentage points or half a percentage point. Hopefully, we should see some big gains on those as well. No predictions or anything like that. No, this isn't a solicitation or anything for that, but that's just the status of the system as of this last Friday when I last updated this. So then we just do it again a couple hundred more times. So far in 9.5 years, we've placed 1,024 of these trades. So you'll also notice on this column, we also have a column for options. So I'm not sure how familiar with options this this crowd is, but just to give you the extreme basics on options, you'll see there on the two right-hand columns, you'll see one of them shows a 1 times ETF option, the other one shows a 2 times ETF option. For example, if we were going to buy the option on the DIA, we would be buying a push stance. So to buy that put option, you notice it says DIA 160916. So that stands for the ETF, DIA. 16 is the year. Options people are always weird, so they always want to change things around. So they put the year first. That's just a joke. I'm an options guy as well, but we are weird. You know, that's just part of it. So DIA 16 stands for 2016. 0916 stands for September 16th of 2016. And then the next character is a P. So it's only going to be a P or a C, or a put or a call. And then several digits over, you'll see that it's at the 187 strike price. So right here in this one concise chart, we show you, let's just use the DIA as example. We entered this trade 26 days ago. It's currently down 0.5%. We're in a bearish stance. If we wanted to enter this trade, we would either short the DIA, right? We'd go short on the DIA, or of course there is a inverse to the DIA that we could trade as well and just buy that. Or we could trade the 2 times ETF, which the 2 times ETFs for the DIA are the DDM and the DXD, which we show you in the second column. And then the third and fourth column show, okay, well, if you want to do that, you would buy the DXD. And then if you wanted to do the options, you would, we select these options for you. Of course, you can trade any option you desire, but these are options that are specifically picked from our engine designed to trade the way that we like to trade. And we'll talk a little bit more about that in a second. So we have gone to a lot of trouble to provide the best option for you using our proprietary engine that knows the way we like to trade. Our preferred method of trading is to use the second column, which is the options on the double ETFs. While the 2 times ETFs don't generally perform double the 1 times index, they do generally perform better. There are a number of strategies which we've alluded to, which we're exploring when we have the hard data. I'll share those with them as they come out. We're probably adding an additional sector to the BRIC, which is the Brazil, Russia, India, China sector here very soon. But for now, let's just keep it simple and let's make some money. So for those of you who have not traded options before, I'm not sure how pertinent this is to our whole audience today, but surely some of you have not traded options before. But we're talking about trading options that in a way that actually carries less the risk than the underlying stock. What we're trying to do is we're looking to proxy for the stock, not a high flyer, 1 in 200 chance of hitting pay dirt at the racetrack type of option. So what we're doing is we're buying options typically with a delta, if you're familiar with options, between 70 and 75, because what are the reasons for that? If I buy an option with a delta between 70 and 75, and this is a generality, of course, and the market goes in my favor 2 or 3 strikes, what happens to that option? Well, the delta of the option is quickly going to approach 100. Once the delta of the option approaches 100, all of a sudden, bada bing, bada boom, what do we have? Well, we have a mini version of the ETF. What I'm simply saying, without getting you confused in options technicalities, if an option has a delta of 100, it's a mini version of the ETF that we had to put much less money into to control the same amount of stock, obviously. Okay, so we're looking for in the money options, and typically have a delta between 70 and 75. Okay, so the number one mistake that most people make in buying options of any type, outside of buying too close to expiration, which we've talked about, we never hold the options within 30 days of expiration, is that we invest too much in the option. In our system, we strongly recommend you only purchase the same number of options contracts that would take to, if you have the cash to buy that same number of underlying ETF. So by buying far into the future, we typically buy in 4 to 6 months in the future. We never hold within 1 month of expiration. You're going to get the majority, if not of all, of your premium back, and you get the gains you're looking for without the risk. Okay, most people look at the daily options fluctuations and get strange beasts crawling around the pit of their stomach, but if you evaluate your losses in the terms of the fraction you've invested, there is no reason to invest in in the options. Okay, so another, the fifth way that we have of trading this is what we call our best-in-class buying. Let's say that we get a signal to buy something in the gold sector, which is the HUI, which is we use for our gold miners index. We know that anytime that we make one of these trades, we know that we are taking advantage of some of the high flyers, but also we're buying into some mediocre performers. So what we do is we allow you to, let me pull up the chart here. We have a component section, and in the component section you can see, for example, in the DIA out of the Dow 30 stocks, at this particular date, this isn't current or anything like that, so don't go out and buy these or anything. But on the date that this was current, that it was Alcoa, Chevron, and Boeing were the three highest performers index. So get this. So the entire Dow index, the entire Dow sector is bullish. It's rising up. The entire sector has, the large cap stocks in the economy are rising. But then we're just going to cherry pick the top three and either buy the stock in those, or of course you can buy the options in those as well. So in that case, we'd want to spread the risk. So we'd buy options in Alcoa, Chevron, and Boeing. Okay. So, and of course, we provide those options for you as well. Of course, that's how are these stocks ranked? You may say, well, we look over the last 10, 15, 20, and 30 days, weight the gain, the underlying sector, the underlying ETF, and add them all up together. And so you're seeing the stocks they're performing relatively better against their own sector. And so we're kind of skimming the cream off the top. So the system is normally too volatile to chase. There's not any time to wait for confirmation. We will, of course, give you the closed trades list if you'd like to take a look at it. The average trade length is about 12 days, so we get plenty of opportunities for compounding. We're in and out of these trades quite a bit, but there are quite a few trades that last only 1 to 4 days. Currently, right now, we're in some longer trades, which is kind of abnormal for us. We have some trades that are 50 or 60 days old, which is, obviously on the long side. But the whole idea of this was to provide folks with a completely mechanical vehicle. I wanted something for myself and something for my students that I could just give them and say, okay, as the baseline, as the core of everything, just trade these. And then, of course, we can learn about the options and all the other different potentials, on a more advanced basis. So who might be interested? We're going to have some time for some questions. We're supposed to go about 35 minutes and then have 15 minutes for questions. So as you're thinking of your questions and typing those in the questions box, I'm going to go ahead and go through a quick offer of exactly what we're offering today. And then we'll go ahead and answer questions for about 10 or 15 minutes, and then we'll wrap up. My 2 or 3 minute commercial for the ETF tipping point. Who might be interested in this barrel? Plain Jane ETFs is averaging 3.04% a month across 9.5 years. So this is the shot as of last Friday where we're at. So, obviously, no system is going to have 100% back. But we're pretty confident that our existing trades are all going to work out. I'm looking for a big market sell-off tomorrow. Hopefully you are too. So what does this amount to? Well, this is a hill of beans, and that's what all of this amounts to unless you take some action on it. Like I mentioned, I didn't grow up with a silver spoon in my mouth. I grew up in a small dairy farming town that's featured in the movie Napoleon Dynamite. But here's my offer to coach 25 of you. This is something that I've become very good at over the years. I'm not a novice to selling on the internet and coaching and educating people and training people. So my offer is for 3 years access, which is a 50% discount. If you go with the 3 years right up front, I do give you basically, I throw in almost everything else that I offer. I throw in my advanced options course, which we sell all day long for $1,500. I give that to you for free. I give you the DVDs of my $5,000 options, advanced options workshop that I did here. We give you those DVDs. I give you the complete trading course for my weekly option science course, which we sell for $500. All of those bonuses for the people who go ahead and purchase the 3 years access for $2,997. For those of you who purchase the $997 access for 6 months, to get started, that's perfectly fine. We don't penalize you for that at all. Anytime during the 6 months that you're a student of mine, you can go ahead and upgrade and pay the difference between the 997 and the 2997 and get all those additional bonuses. So we're not going to penalize you for that. Okay, so I hate overhead. I could get a fancy marketing and get some full-time sales guys and all of that. So this is a screenshot of my office. This is where I'm at right now. If you were to stop by at 122 North Raymond, Suite 1 in Spokane Valley, Washington, I'm here. We're not some fly-by-night operation. We've been around for, we plan to be around for a lot more years. What that means is, if any of my students, and we have this happen quite frequently, are in the neighborhood, about 5 hours east of Seattle, Washington, in the town of Spokane, Washington. I know not exactly a super well-known town, but of course it's the home of Gonzaga. You drop me a call and we'll go ahead and give you a tour of the office and go to lunch, which is, I love my customers. I love this market. I love dealing with traders and investors. So this is something that I really enjoy doing. But instead of dealing with bigwigs and hedge fund managers, I'd rather enjoy my free time and deal with just a few customers. Like Dean, we don't have actually time to go through Dean's whole testimonial. I'm going to put my money where my mouth is on the system. I'm going to take the majority of the risk by giving you an ironclad 2-part process. That's pretty standard. Part 2 is learn the system, use it for a full 6 months, executing all the trades that come up. And if you don't at least make the system investment back, I'll personally work with you for free on my dime until you do. That's me working with you personally one-on-one until you get this figured out. That's how confident I am in this system. And in the 9.5 years that I've been doing this, I've only had to deliver on part 2, I believe it was 5 times. 5 times people either couldn't get the trades figured out or had a extremely improbable losing streak that I had to invoke part 2 and step in and help them out with that and continue to work with them until they got their investment back and were profitable. So either way, you love it and you make good money with it, or you hate it and you get your money back. I don't think we can be much more fair than that. At the end of this, we're either going to part as friends or we're going to part as friends. That's the only conclusion we can come to. We do have additional bonuses for the first 25 people that sign up today. There's several hundred of you on the line today. Number 1, we're going to make a donation in your name to Kiva.org. Kiva.org supports third world entrepreneurs all around the world. I'm a big believer in that. I donate every single time we make a sale. I donate to that organization. What you need to do is call our secure voicemail number at 509-720-7867. Leave a detailed message with your full name, address, phone number, and email and credit card, along with which of the 2 packages you like, and we'll return your call ASAP to confirm and process your order and answer any questions. Or, of course, you can order online by going to etftippingpoint.com/6month or etftippingpoint.com/3year. So with that, we'll go ahead and take any questions. We have a shot of our most recent workshop here in Spokane, Washington. Here's the hotel that we hold it at, the Davenport. It's a $25 million hotel renovation that they did here in town. It's probably the nicest place you can find between Spokane and Minneapolis. We're kind of out of the way, but it's an extremely nice place. So again, to order one of the 25 spots, call the secure voicemail line 509-720-786/6month or etftippingpoint.com/3year. So again, we're all about getting above market returns, lots of compounding, and all of this in less than 15 hours a week. So let me go and make sure we got everything covered. This is our current stats as of last Friday. I'm going to go ahead and scroll back through the questions to make sure we get all the questions answered. And then we'll turn the floor back over to Mr. Bigelow. So let's say this is from JD from Puerto Vallarta. Great warranty, thanks. Yeah, no problem. We have no problem with backing up what we sell. Paul Wyman says, is the options course $1,500? Yes, we do have. We include that as a bonus for people who purchase the ETF tipping point. This is Vina Prince. She says, I want to take the option course. I don't know nothing about options. I trade futures and how much the option course costs. Yeah, the options course is $1,500. That's my advanced options course. Kind of the stuff we covered today would be, options, not even 101, options 90A or something like that. The phone number to call in is 509-720-68, 509-720-7867. Dials right into our office. That's our secure encrypted voicemail line. Leave your full name and address, phone, email, credit card, along with your choice of which of the two packages, either the 997 or the 2997. We'll return your call ASAP to confirm and process your order and answer any remaining questions. Okay, I'm going to go ahead and answer any other questions that have come up. Let me scroll back through here for a minute. Here's some options. This is a question for, let's see, how big a sell-off? Ouch, why? I think the sell-off is going to be huge, massive. There's already some other things brewing for a bearish market. And I think all this Brexit stuff is going to only make the problem worse. So I think we're in for a pretty big sell-off, which I actually prefer. You know, in all the systems that I trade, it's easier to make money in a bear market than it is in a bull market because markets crash down, not up. So if you want to make money quickly, a bear market's the place to do it. This is from JD. He's talking about the HUI, gold trackers, GDX, NUGT, all of those. We used to use the HUI, and the old version of my system uses the HUI. We're now using the GDX. This is from JD. Says delta of 70.75, option approaches 100, bada bing, bada ding. Is that a technical indicator or voice activated? Now that's voice activated. You have to do that yourself when the market moves that much. JD's just joking with me there. Okay. Will there a link to be recording this webinar for my personal review? Yeah, I believe so. I'm sure that Mr. Bigelow's office is getting the recording of this for everyone. Hopefully the audio turns out okay. I have no idea why we would have that audio problem after I fixed the Wi-Fi thing. So hopefully it's not a problem on my part. I feel terrible if it's a problem on my computer part. Okay, we had some comments. I might be interested. The price is right. Okay, well, the price is on there. It's $997 for the 6-month access or $2,997 for. This is from Johnny P. He says, what is your unaudited monthly return? The unaudited monthly return, let me go to that. This is from Barbara. She says, how do you train us? We train you with online webinars. We have a monthly coaching that we take you through to walk through our current state of the system. We have about 3 to 5 hours of video on the membership site that details exactly how to place the trades. And then we'll just have kind of non-scheduled webinars where we just train you on a poll of all the members and say, okay, well, what's the next big thing you'd like us to research and give you a content webinar. Tom comments, pound plummets on early Brexit results. Yep, something's going to happen. Volatility is way up. Lou says, futures are coming back. Yep, absolutely. I think futures are coming back. Maybe he's talking about coming back. The futures market is turning around right now. We'll see. I don't know. All right. So any other last questions before we wrap up? Well, this is probably a different change of pace. Hopefully we answered a lot of your questions. We're not trying to be all things to all people. We don't trade 27,000 different markets or anything like that. We trade 9 different sector ETFs, and we offer those signals and input on exactly how to trade those, averaging over 3% a month for 9.5 years. So it's been one of those things that's been a huge blessing to my family. Been something that I have fallen in love with, this concept of getting small wins, singles or base hits, and then compounding with profits that we've already taken out of the market. All right, well, I think that's about it. I think my time was supposed to be right at 50 minutes, and I think we're getting really close. It's supposed to be 35 minutes of content and 15 minutes of Q&A, so didn't quite have 15 minutes of Q&A. Sorry about that. Try to get all the questions answered we could. Sherry asked a great question. What was your biggest loss in a given year? 2011 was probably, and I don't have the exact numbers off the top of my head because nothing much happened that year. I don't think we lost anything that year, but we were only up a little bit because in 2011 the market basically traded sideways all year, and we didn't get hardly any signals generated. Our best year was 2008. So while everybody else was crying and moaning, we had a record-breaking year, over 100% in 2008, easily over 100%. All right, well, we'll turn it back over to Mr. Bigelow. Thanks, everyone. Thanks for being on.
Thank you very much, Kurt. Everybody, if you want to have a different perspective, we're trading the ETFs and maybe not as fast or having to sit at the screen every day, this is an excellent program to use. So with that, Kurt, thank you very much. And everybody, have a good evening. We will see you in the chat rooms.